All right, welcome back here to Trader Minute. Great to have you aboard. Let's go out and take a look and start to break down technical indicators. To this point, we've talked about some of the theories or assumptions that we make when doing technical analysis. We've also talked about support and resistance, perhaps one of the most key factors in dealing with technical analysis. But remember, when it comes to technical analysis, we're studying pure price action. That's it. We're studying the price action. We're not taking into account, PE ratios and earnings and all those fundamental factors. Technical analysts pull in just purely the price action in an attempt to look for repeatable patterns. Okay, repeatable being the key part. And one of the things you'll find is that technicals that work in one market may not work in another, or technicals may start to work for a brief time and then they stop working and then a different way works. Okay, it's ever changing, and that's one of the difficulties, challenges, and also part of the fun of technical analysis overall. Okay. Um, these technical indicators, okay, and let me show them to you here. We have, if you kind of come down here below under indicators, stock charts has a whole bunch of them, okay, they have a bunch of them, but they don't have any relative to something like Thinkorswim. Thinkorswim here, we can come up here into their charts and pull out some studies here, and I mean, there are just tons of ways that we can look at technical analysis and all types of different indicators that we can add. You can even go and create your own and put it in here. Technical analysis is kind of a new frontier for the markets that's continuing to evolve and continuing to progress. But no matter how we look at indicators, okay, they're all attempting to do the same thing: find a price pattern. They're all breaking down the price of the stock in one way, shape, or form. But they tend to have three major categories. Okay, they tend to have three major categories, and so let's go take a look at these categories, and then let's go break down some of the indicators in these categories. So, category number one, let's take a look here: oscillators. Okay, oscillators. And we'll take a look at things like the Williams percent R. We have the stochastics, and let's go with the CCI. Okay, the Commodity Channel Index. Those are three good examples of oscillators. Then we have our trend indicators. Okay, we have our trend indicators, things like the MACD. Okay, MACD, the rate of change, which we looked at in our last class. And then we'll go take a look here at the ultimate oscillator. They call it an oscillator, but it's really a measure of trend. I just like the name. Okay. And then the third category of indicators are volume indicators, where they're basically not just looking at pure price action, but they're bringing volume into play in one way, form, or the other. Perhaps one of the most common is volume by price. That indicator, the MFI, which we looked at with support and resistance. And then we're going to take a look at something called the Chaikin money flow, which in the short term, a little tough to use. In the long term, a really, really nice indicator to understand the overall trend in regards to stock volume. Okay, so oscillators, trend, and volume. Okay, one of the mistakes that a lot of new technical analysts will make is they will go out and they will set up their chart like this. Okay, they'll come down and they'll look and they'll say, let's put on an RSI, which is an oscillator. Let's put on a slow stochastics, which is an oscillator. Let's put on a Williams percent R, which is an oscillator. And let's put on a commodity channel index, which is an oscillator. Okay, and they'll bring up the chart, and I'll put two of these indicators above, two below. They'll bring up the chart, and they'll say, well, And they'll look at all 4 indicators and say they all kind of look the same. In general, oscillators, when they're high, they're trying to find a point where the stock is going to pivot or reverse and go lower. When they're low, they're trying to find a place where the stock is going to pivot and potentially go higher. Okay, so, stochastics below 20, okay, stock should probably go up. RSI below 30, stock go up, support. Look at Williams percent R, below minus 80, stock should go up. Notice how, while all these indicators look pretty much the same, they all move in the same direction, the scales on them are just a little bit different. Okay, and they're a little bit different because of what they're measuring, but essentially they're measuring the same thing. They are measuring whether the stock price is high or low relative to its past history. That's what an oscillator is. Okay, oscillators measure. Okay, they measure whether the stock price is high or low relative to past history. And that's it. So you throw on 4 oscillators, they're all going to look the same. The last thing I want to do is try to make a trading decision based on 4 oscillators because, hey, they're all going to look the same. There's no reason to complicate it like this. Okay? So I want to use 1 oscillator, max 2. I want to understand where the oscillator is or whether the stock price is high or low relative to its past history. Now, when it comes to oscillators, there's a million ways to look at these. Okay, Wells Wilder, who developed the RSI, okay, he basically said if you gave him a chart and gave him just the RSI to trade off of, he could never make any money. He'd lose more than he won. Okay, the developer of this indicator admitted it, and that's the way most oscillators are. Okay, most oscillators aren't going to call tops. They're not going to call bottoms. They're going to be very difficult in understanding the overall trend. Okay, but in general, oscillators when they are low. Okay, in fact, let me annotate this to show you. Let's just take the stochastics here. Okay, below 20. And we have the Williams percent R below minus 80. Okay, so kind of the same thing. And the stochastics is below 20. At the same time, the Williams percent R is below minus 80. But in general, when the oscillator starts to move out of its negative territory, so for example, the stochastics moves from below 20 to above 20. When the Williams percent R moves from below minus 80 to above minus 80, that's a bullish sign. Okay, that's a bullish sign. And when the oscillator moves from above 80, okay, on the stochastics, for example, okay, we go from above 80 to below 20, or the Williams percent R goes from above minus 20 to below minus 20, generally a bearish sign. Okay, generally a bearish sign. Now, if you're only using an oscillator, be prepared for whipsaws. Okay, what do I mean? Well, look back here. Let's look back here in August. Williams percent R moves below minus 20. The stochastics a day later moves below 80. Even the CCI, which same principle, goes from above 100 to below 100. Okay, all 3 of them break down. All 3 of them break off from their high points, give sell signals, and the next day the stock, boom, 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 chunks higher in a significant fashion. Okay, oscillators are perhaps the most prone indicators to whipsaws. Okay, oscillators are the most prone to whipsaws. Let's break each one of these down a little bit more. Let's take the stochastics, which is my favorite oscillator, okay? Of all these oscillators, the RSI, the CCI, you name them, the stochastics is my favorite. And generally, I'll use a slow stochastics. But let's pull these up. I want to show you the slow, the full, and the fast stochastics. Okay, because there are three of them. Okay, and notice here how the slow stochastics and the full stochastics are essentially the same thing. Okay, they're essentially the same thing. We can make them so they're a little different by adjusting their parameters, but the fast stochastics is a little bit all over the place. Okay? A little bit all over the place. It has to do with how the data or the price action is calculated. Okay. One of the nice things here on stock charts, and you can do this without a membership, but you can come in here to Chart School. Okay. You can come in here to Chart School, and it's up here, Chart School, and then down to Technicals, Indicators, and Overlays. And you can bring up any of these indicators, and it'll show you exactly how they're calculated. Okay, so here they have the stochastics oscillator. Okay, the stochastics oscillator. How's it calculated? You want the math? Here's the math. Okay, percent K, current close minus lowest close, divided by highest high minus lowest low. You can get that much into it. Okay. It'll then kind of give you some examples and different things, interpretation, show you the fast, full, slow, kind of how they all play out. Okay, look in general here. Okay, the stochastics oscillator, the most common way to look at this is from a 14-day period, and the fast stochastics basically kind of takes a 14-day moving average, okay, on its percent K. So the black line here on the fast stochastics is just showing whether the stock price is high or low relative to its past 14-day range. And that's it. Stock price high or low relative to the past 14-day range. Okay. Look, when we're high up here in September, okay, we can see that on the chart. We know the stock is high relative to what it's been over the past 14 days. I mean, we know that right now Nucor is high relative to what it's been over the last 14 days, right? I mean, pretty easy. Right? The percent D, or our red line, okay, it says 3, is basically a 3-day moving average of the black line. So it's kind of a way to smooth it, okay, a way of smoothing the stochastics. And then kind of one of the ideas that stochastics users will make is they'll say, hey, when the black line, okay, or our percent K, okay, percent K moves above our red line, or our percent D, okay, we buy. And then vice versa. Okay, vice versa. Now, it doesn't take too long to look at the stochastics indicator and realize that if you take that strategy, you're going to be whipsawed all over the place. Almost on a daily basis, you're going to be whipsawed. Okay? So, what did they try to do? Well, they tried to smooth the stochastics oscillator. So they essentially said, okay, let's take our percent D from our fast stochastics, and let's make that the percent K for the slow stochastics. Okay? So the percent K for the slow and the percent D for the fast are the same thing. And then what they do is then they get a percent D for the slow stochastics that they say, okay, that's a 3-day moving average off of the percent K of the slow stochastics, or off of the percent D from the fast stochastics. So it's kind of a triple smoothing mechanism. And you'll notice how the stochastics, the slow, is much smoother in general than the fast. Okay. Using this same concept, black line move above the red line, you buy. Black line move below the red line, you sell. Okay. You'll still see that there are whipsaws. Okay. There's plenty of whipsaws still to be had, but not nearly as many whipsaws as what you see down here on the fast stochastics. Okay. not nearly as many whipsaws. Now, one of my favorite things to see with the stochastics, okay, one of my favorite things, and it made it a lot easier to get into this new core trade. I had Vibe Trend Rider principles, but take a look at the action here on the stochastics. We get the black line moving up above the red, coming out of an oversold area below 20. Okay, which is inherently bullish, but if we just played with that and only bought with that, we'd do pretty well in a bull market. We'd do pretty lousy in a bear market, and in a choppy market, flip a coin. It's not really going to give us a whole lot. But notice then how the stochastics turns negative shortly after. So we get the positive, then the stochastic starts to turn negative, and then the stochastics makes that second cross up. Okay, it gives us this kind of divergence here, very similar to back here in June. Okay, very, very similar. Okay, those are really nice buy points. Okay, they tend to be one of the most accurate ways to play with the stochastics. Okay, tends to be one of the most accurate. Where the opposite, okay, the downside, where you cross down from above 80, okay, then you cross up, and then you cross back down from below 80, that tends to be a really nice sell point. Okay, a really nice sell point, and you're oftentimes able to capture a pullback on the stock. Notice here in September, it never really kind of gave that kind of double action. It was single, just went down. Here in November, it gave the double action. Okay, where we get the down followed by the cross up in the stochastics, followed shortly by the next down. You get some downside pressure there. Okay. So on the stochastics, I kind of like looking for this three-pronged approach, where from a bullish standpoint, you get a cross up from above 20, then you get a cross down, somewhere around 50, sometimes a little above, sometimes a little below, and then you get another cross up that starts to take it back higher. Those become very nice buy points here for the stochastics. Okay. The other thing I like about the stochastics, okay, is, and I haven't seen one for a little bit, generally as the challenge gets rolling, I'll make a lot more trades kind of based on this. But take a look here at Boeing and the slow stochastics and bouncing right off of 20. Okay, not 19, not 21, right off of 20. Doesn't happen very often, but when I first started trading, a gentleman by the name of John, he would help me out. Not the John on Trader Minute here, but years ago, and he was a very seasoned trader, and him and I, we would sit down. He would show me different things, and remember one of the first things that he showed me, one of the first little tricks that he showed me was he pulled up the stochastics and he said, "I hate this indicator. It doesn't do any good. It has no real bearing, no real indication in his opinion." And he said, "But I look at it for every stock because when the indicator, the black line, rolls off of 20, okay, that exact number, it tends to be very bullish. When it rolls off of 80, which we don't have for Boeing, we don't have any examples of that. Here you could argue, yeah, rolling off of 80, but not exact. When it rolls off of 80, that is very bearish." Okay, and he would basically look and play some of those. Those of you who were on the challenge that we did last November as we mounted gains, you remember we played some of these where we kind of bought right off 20 and sold right off 80. It's eerie how often that tends to work. Just a nice little trick from the stochastics here. So, we could play it a couple ways. We could play it with the divergences, right? Okay, here on Boeing, we get oversold below 20. Okay, crosses up, crosses back down, then makes the next cross up. That's a very bullish position for Boeing to be in. And generally, it'll continue that bullishness for some period of time. Okay. So that's the stochastics oscillator. Another oscillator there is the CCI. Okay, I'm going to clear out, and the CCI calculation is just a little bit different. It's just a little bit different here overall. The scale is going to be a little bit different. Okay, overall. And generally above 200 is overbought and below minus 200 is oversold. Okay, above 200 is overbought, below minus 200 is oversold. Okay, but just like any oscillator, overbought does not mean that the stock can't keep going up. And oversold doesn't mean that the stock can't keep going down. Okay, in fact, a lot of times you'll see that, oversold stocks continue to fall while overbought stocks continue to rise. But it gives you a good idea that, hey, maybe we're a little bit too overbought and we could be in for a strong correction. Okay, so anything over 200 on the CCI, I start to get pretty nervous about if I'm long, and I'll look to kind of take some profits. Anything below minus 200, I'll look to get long or look to take profit on any put plays that I may have on it. Okay. So 200 minus 200, they're not magic numbers or anything like that, but they're generally the ranges on this oscillator that tend to show the overbought, oversold, where you can start to see a little bit of a correction come in. Okay. Oftentimes, I will use the CCI more on an hourly type basis or even on a 15-minute type basis. But keep in mind that gaps will kind of throw this indicator out of the water. When a stock gaps heavily, generally you need to wait kind of 20 periods. So on a daily chart, if it gaps up, signals an oversold on the CCI, generally you want to wait 20 candles to really say, okay, now I can start using my CCI again. In the same with the hourly or 15-minute. You get a big gap, you need to kind of wait, let it kind of reset, and get rid of the gap out of that calculation. Now, the other oscillator here, is the Williams percent R. And many years ago, I was presented by somebody who used this Williams percent R, and they basically used it in this way. They went out and they looked for stocks on the Investor Business Daily that were tops, okay, that were the highest recommended there on the Investor Business Daily, and they waited until the Williams percent R went to above minus 20. Okay. Now somebody say, hey, you know what? That just hit an overbought position. You shouldn't be buying in an overbought, but it was very accurate. Okay. You had a strong performing stock with good fundamentals. Williams percent R goes above 80. You buy. Okay. And basically the stop was on. They didn't say, well, Williams percent R goes below minus 20, you get out. They basically would find a support level and use that to get out. And it was a really, really effective trading method, and did really well. And most stuff that Williams percent R triggered on, those stocks went higher. Okay. Then something happened. 2007 came. Market hit its top, and literally every bullish signal on the Williams percent R that was being used actually became a sell signal. Okay, the market shifted, the market changed, and you could actually go out, and when the Williams percent R hit below minus 80, you could go short the stock, and you would do much, much better than buying anything above minus 20. Well, that has recently shifted. Over the last 2 years, anything above minus 20 can pretty much be bought, while anything below minus 80 can pretty much be bought. What's that a product of? That's a product of the market trend. Okay, that's a product of the market trend. So the oscillator Williams percent R overbought above minus 20, oversold below minus 80. But when the market's in some sort of trend, you can kind of use and buy those overbought positions because you know the chances of them staying overbought for a longer period of time are much higher in a bull market. And in a bear market, you know, staying oversold for a long period of time is much that the chance of that happening is much greater. A lot of people will talk Williams percent R and say buy when it goes buy when it goes above 50. You know, if you want to pick a midpoint on an oscillator and say I'll buy when it goes above it and sell when it goes below it, please don't make that your only factor because the whipsaws on that will be tremendous. Okay, they will absolutely be tremendous. You'll note that with the RSI for the trend rider, right? We're looking for the RSI on a trend rider bull signal to go above 50 and the RSI on a trend rider bear signal to go below 50. Well, the only reason we're looking for that is so that we know that the stock has had some sort of consolidation or pullback. There's nothing magical about that 50 level, but for the trend rider, it helps to understand, okay, we've had some sort of pullback. It's a little safer to be a buyer, or it's had some sort of uptick. It's a little safer to be a seller. Okay, and we could easily use the Chike or the CCI. We could use the MFI. We could use the Williams percent R, stochastics. Any of these oscillators, we could pretty much use for that same thing. Okay? So oscillators, they basically show whether your stock's high or low relative to its recent price action, and that's it. Okay. The biggest danger to oscillators are gaps. Gaps throw oscillators out the window for a brief period of time. Okay. Now, the second category of indicators, second category of indicators are your trend indicators. Okay, your trend indicators. MACD, rate of change. I'll show you one called the ultimate oscillator. Okay, but these are generally nice to understand the overall trend of your stock. But you need to keep in mind that stocks trend on about an average of 40% of the time, and they oscillate about 60% of the time. What does that say about a trend indicator? It actually may be less accurate than it is accurate. And we can see that when we go and look at these. Doesn't mean these trend indicators don't have a time and a place, but we got to keep that in mind. Okay? Let's start by just adding these in here. And I'm just going to add a MACD. I'm going to add let's go add a rate of change. And let's go add an ultimate oscillator. I'm not going to spend a lot of time on the rate of change as we looked at that in the last class. Okay. But let's take a look at them. You'll notice that their overall movement appears to be very similar, right? Just like with the oscillators, okay, with the stochastics and the Williams percent R, CCI, they all kind of went in the same direction. Your trend indicators will tend to go in a very, very similar direction. Okay. The MACD, okay, the MACD here, 12.26.9. Basically, what this is doing is taking and playing with moving averages. So I could recreate the MACD by just adding some moving averages. Okay, and let's just add a 12-day moving average, and let's just add a 26-day simple moving average. Okay, those are our parameters here for the MACD. Okay, 12 and 26. And I'll just take off. I'm going to change the type of the chart to invisible so we don't see the candles. Okay. Let's just take a look here. Notice how when the blue line, or our 12-day moving average, okay, pushes above our red line, we tend to have both stocks or both the stock go higher. Okay. When our blue line pushes below the red line, we get a little flattening or consolidation. Okay. Recently, we had a blue line go above the red line. What is that? Well, that's just these MACD crosses, where our black line's going above our red line. Okay. All that this is showing, here is our 12 and 26-day moving averages. Okay. Now the 9, okay, basically calculates that distance or that distance here between those moving averages. Okay? So basically we have when the smaller moving average moves above the larger moving average, that's bullish. Okay? When the smaller moving average moves below the larger moving average, that's bearish. Okay? That is bearish. Okay? Now, most MACDs will actually use exponential moving averages. That's why you'll see a little bit of they're not fully correlated on here because I put simple moving averages. Okay? But the concept's the same. Okay? And basically, it's the whole idea of a moving average concept where it's bullish, okay, when a smaller moving average crosses above a larger moving average. Tells you the stock has momentum. And then it's bearish, okay, when a smaller moving average crosses below a larger moving average. And basically, the MACD is just taking advantage of this. It's just taking advantage of this concept. Can it have whipsaws? Yeah, absolutely, and it will. Okay, but it's taking advantage of the fact that when a smaller moving average starts to move above a larger moving average, that creates a very bullish environment. Now, we don't have to use just a MACD to kind of get that concept, right? We can come in here and just let's take a 3-day moving average and a 7-day moving average. Let's kind of shorten it, okay? And we can be a buyer when the 3-day moves above the 7, okay? And we can get some runs. Sometimes we'll get some whipsaws in the consolidation periods. Okay? We could buy a buyer when the 3 goes above the 7 and a seller when the 3 goes below the 7. The shorter your time frame, the more whipsaws you're likely to get. The larger your time frame, the fewer whipsaws you're likely to get. Okay? So if we come in here, let's just take a 10-day and a 20. 10 and a 20. Notice how we don't get nearly as many signals or nearly as many whipsaws. Okay? But bullish when our blue goes above our red, bearish when our red goes below our blue. And so essentially we can come down and change the parameters on the MACD to match that. We can use whatever moving averages we want, and we can kind of match that whole idea there. Okay? So MACD is basically a manipulation of moving averages to kind of understand if our moving averages are in a bullish or bearish position, thereby measuring trend. It's one of the oldest technical indicators, developed by a gentleman named Gerald Appel back in the 60s. And it has withstood the test of time. A lot of other indicators that were developed 60s, 70s, even 80s still aren't around. But the MACD has withstood the test of time, and that's because of its ability to kind of look at trend overall. You can use the MACD as an oscillator. I won't talk about that here, but you can spot high points, low points, kind of in the long term, but it's not nearly as good as understanding the broader momentum here. Okay? All right, now the rate of change. Okay, rate of change. We talked about this in the last class about being kind of a second derivative. When the rate of change is moving higher, that tends to be very bullish, while when the rate of change is moving lower, that's very bearish. A lot of times, I didn't show this in the last class, but a lot of times it's not a matter of what the rate of change is doing today, it's the trend breaks. So the rate of change has shifted. The trend here on Boeing has shifted. The downside rate of change, deceleration, okay, that led to a consolidation, now has shifted to an upside rate of change, which is a very bullish aspect. When the downside here finally broke, we started to move into an upside rate of change. You see a really nice move, typically in the stock price. Okay. All right, so that's the rate of change. Now, below here, the ultimate oscillator, and I admit I don't use this a lot. Okay, I don't use the ultimate oscillator a ton, but its concept is really neat. What it's trying to do is measure momentum in various time frames. Okay, so in this case, 7, 14, or 28 days. So it's taking various time frames, putting them together, and saying, okay, what's going on here in these time frames? Are they starting to match? And it can give overbought and oversold territories, very similar to an RSI, where above 70 overbought, below 30 is oversold. Okay, but generally with the ultimate oscillator, it comes down to what is the trend of this oscillator. Okay, is the trend lower or higher? Here with Boeing, there's not a whole lot to make out from it. It's the ultimate oscillator's really just been whipsawing above and below 50 for a month and a half now. Okay, kind of like back here in June, July, August. There's really not much to make out of it, or to kind of look at there. What in general people try to look at, let's take Bed Bath and Beyond. Okay, is there any sort of divergence going on? Are we starting any sort of ultimate oscillator trend? Okay, notice here on the ultimate oscillator that it broke down. It had been kind of holding support here around 45, the ultimate oscillator, and it broke down and whipsawed back. That tends to be a very bullish type of action here for the ultimate oscillator. Theoretically, you can be a buyer when it moves above 50 and a seller when it moves below 50, but you can see how much it bounces, how much it moves. Okay. The ultimate oscillator was developed, many years ago, back in '76. It was made famous, in a book that I forget his name who developed it. But it's been one of those oscillators that is not around nearly as much as the MACD, even though it has a cool name. But it just doesn't typically give you great buy-sell signals. Those that like playing with indicators and divergences, it can be a nice indicator. But I find that the ultimate oscillator doesn't give me anything that the rate of change or the MACD can't give me on a daily basis. Now, if we take a look on a weekly basis, we can take a little bit more out of it. We can take a little bit more out of the overall trends here on the ultimate oscillator, but I don't think any more than what the MACD and what the rate of change already give us. Okay. In the momentum indicators, there's a lot more of them. You have things like the ADX, you have things like the TRIX here, which is a pretty good long-term indicator. Okay, and you'll notice it looks similar to the MACD here on the TRIX as far as what that overall does here. You'll notice the TRIX is kind of bearish here for Bed Bath & Beyond on a weekly basis, but the TRIX on a daily basis is actually kind of making that black line above red line, which for momentum oscillators is a very bullish sign. Okay, a very bullish sign. Especially here with Bed Bath & Beyond. So, it really comes down to which one do you like, which one are you more comfortable with. For me, the MACD rate of change, done. I have my momentum indicators. I can use moving averages as well. Adding more like the ultimate oscillator or the TRIX doesn't add a tremendous amount of extra analysis to the trade. Yes, AK, I agree with you. Ultimate Oscillator sounds like an awesome fair ride. No, it does. Absolutely. Right? I mean, even for an indicator, it's the name that kind of grabs you, right? But there you go. Ultimate Oscillator at the fair. Better not eat too much fair food before going on that, huh? All right, so let's take a look here. So we have our oscillators, we have our trend indicators, and then we have our volume indicators, okay? Now, you'll notice with the Williams-R, stochastic, CCI, ultimate, rate of change, MACD, none of these took into account volume. None. All they did was mess around with the pure price action and come up with some sort of calculation based on the price action. Okay? These volume indicators, they try to add that volume element. So the MFI, okay, let's add the MFI here, which is my favorite of the volume indicators, and oftentimes I'll refer to it as the RSI on steroids. Why? Well, the RSI is an oscillator, and the MFI adds volume. Okay, so the RSI, yeah, it'll hit overbought, oversold positions, but I feel more comfortable with overbought, oversold with the MFI simply because that is taken into account the volume into that calculation. Okay. So they're very similar. Okay, they're very similar, and while yes, it brings volume into play on the MFI, it does show overbought, oversold in a way that an oscillator does. Under 20 is oversold, over 80 is overbought, and the MFI can kind of capture more than what the RSI can overall. Okay. Now, I talked more about the MFI in the last class, so I'm not going to spend a ton of time here on the MFI. Two other volume indicators that are popular. The one, probably the most popular, is volume by price. Okay, where are we at here? Volume by, they've changed the name on some of these here. Give me 1 second here. Looks like they may have taken it out. That's how popular it is. But basically what it would do, yeah, let's go on balance volume. It's probably going to be the same thing. On balance volume. So let's take and add an on balance volume here. Okay. Yeah, this is doing the same thing. And basically what it's doing is it's adding up the volumes. It's simply as simple as this. When the volume goes up that day, and the volume is buying volume, or the stock went up, so they count it as buying volume, they add it to the on balance volume. If the stock goes down that day, they add it to the downside or subtract it from the volume. So you kind of get this on balance volume that is showing, okay, are the volumes really bullish? Are they bearish? Where are they going at? A lot of times you can add a moving average. So I'm going to put parameter of 20 here. Okay. So what this is doing is putting an on balance volume with a moving average of 20. Okay. And if your volume starts to accelerate to the upside, what does that mean? Well, your stock's breaking out. Okay. Here we have Bed Bath & Beyond, whose stock price is breaking out, right? But we don't have volume confirming that. That's one of the aspects of the market here where, very light volumes, and so we don't have volume confirming. Where the breakout on Bed Bath & Beyond back here in June, plenty of volume confirming, and the strong surge to the volume to the upside kind of helped to confirm that. Take Apple, for example. Okay. Apple, the volumes have been very bullish, and the on-balance volume has continued to go up. But recently, what's been happening? The volume has been going, the on-balance volume has been going to the downside, telling us that even though Apple popped or had that big gap up, we're still seeing a little more selling volume than buying volume come in. Okay. A little more selling than buying volume come in, and go from there. Okay, so the on-balance volume here. And yes, thanks, River Rat. I did misspeak. Let me show you the difference here. On-balance, or volume by price, is an overlay, and that'll put our volume based on the various prices on our left-hand axis. We looked at this with support and resistance. Okay, so I misspoke. It's on-balance volume here that is kind of subtracting and adding those volumes there. Okay, apologize for that. Okay, so we have the on-balance volume is really going to kind of help us see. One of the things I'm kind of nervous with Apple is some of the volumes, the way the volume story has been playing out overall. Okay, but again, this is only one indicator. This is only one piece of the puzzle. One of the things that happened here with Boeing, okay, the on-balance volume started to push back up. And we started to see some of the buying volumes come in. You'll notice here as basically the market, the volumes on Boeing have essentially dried up. The on-balance volume is kind of maintained pretty flat there. Okay? But a lot of times when you start to see those pick up in volumes, those can be very, very nice upward trends to play. Take a look at Nucor in regards to the on-balance volume. Okay, you see what Nucor's been doing. Nucor on-balance volume hitting a new high relative to what it's been over the last 6 months. That's very bullish. Okay, that's very, very bullish here for Nucor overall. Okay, so on-balance volume, nice from a daily standpoint. Now, Perhaps one of the more popular volume indicator, Chaikin Money Flow. You don't hear about it nearly as much now as you did 5, 10, even 15 years ago. The Chaikin Money Flow is a very, very interesting indicator. Its calculations are a little bit more complex, but essentially the idea here is to trade the volume, where the volume's going. So if the Chaikin Money Flow is below zero, okay, it's negative. Okay, the volumes are favoring the bears. Chaikin Money Flow above zero, it's positive. Volumes are favoring the bulls. Now, on a daily basis, even on an hourly basis, it's whipsaw city. Whipsaw all over the place. I find it very difficult to play on a daily basis. So why do I show it to you? Well, because on a weekly basis, that changes. Okay? On a weekly basis, you get very few whipsaws on the Chaikin Money Flow. You get much more sustained activity. Okay? So, a couple ways to look at this. You can buy when the Chaikin Money Flow moves above zero, sell when it moves above zero, or you can use a cushion. Okay? And a lot of traders who use the Chaikin will use a cushion. They'll say, look, I'll buy when it goes above 0.1, and I'll be a seller of the stock when it goes below 0.1. Okay? So they'll kind of give this buffer zone. And what that tends to do here is when it goes above 0.1, yeah, you know, you're going to have ups and downs and all arounds, right? But in general, the volumes will continue to favor the bulls for a while. Okay, you're more likely to run a longer-term trend to the upside. Vice versa, when the Chaikin Money Flow goes below minus 0.1, you're a lot more likely to run a longer-term trend to the downside. Okay, on weekly charts, the Chaikin Money Flow I find to be a lot better, but it's really better for building a watch list. Okay, so Chaikin Money Flow here on Boeing is bullish. It's been very bullish for a long time, and it's actually continuing to get more bullish here on a weekly standpoint. Okay, that's not going to help us with day-to-day action, hour to hour, minute to minute, but it's going to, hey, I want Boeing on my bullish list. Why? Because the volumes are still favoring the bulls. Starts to go below minus 0.1. Okay, now we'll take a look at it and putting it on the other side of the watch list. Okay, you know, something like Tesoro. One of the new things with Tesoro this year, that last run Tesoro made in October, if it took the Chaikin Money Flows from negative to positive. Okay, you'll notice that even on a weekly basis, and this might change a little, we're pushing up above 0.1 a little bit. This is a very positive overall for Tesoro. Okay, now is that going to look different on a daily basis? Absolutely. I mean, you know, look at Tesoro, the Chaikin Money Flow here. It's saying sell. Okay, but go ahead and try to sell when the Chaikin Money Flow triggers sell and buy when it triggers buy on a daily chart. I promise you'll be more wrong than you are right. It just does not have a lot of accuracy to it at all. Yeah, Chaikin Money Flow here on Boeing. Okay, look at the scale though. Look how small that scale is, kind of relative even to Tesoro here. Okay, the scale definitely has shifted just a little bit because of how little movement there has been in the overall Chaikin oscillator. Okay. Or excuse me, yeah, Chaikin Money Flow here. Now the Chaikin Money Flow they've kind of created an oscillator with it called the Chaikin Oscillator. Okay, that kind of gives you oscillator aspects of high, low. I've played with the Chaikin Money Flow for years, and on a daily standpoint, whether it be the oscillator, whether it be the pure Chaikin Money Flow, it's been fantastic on a weekly basis, understanding which stocks are in bullish and bearish trends. But in an hourly, daily capacity, it's really difficult. Really difficult to see any real accuracy there as far as finding patterns, which is essentially what we're trying to do. Okay, is just fine overall patterns. Okay? Now, notice on any of these indicators, are we talking about something that's foolproof? Are we talking about something that's always going to show? No, what are they calculating? Every single one of these, none of them calculate action to come. They all calculate action that already happened, right? That's the rub. That's the knock on technical analysis. It's measuring what's already happened, not what's going to happen. And so, can you look at indicators? Well, it worked before. Does it have to work this time? No, not necessarily. And that's where the game of technical analysis comes in. What do you trust? What do you not trust? Okay. Over the years, okay, and being involved in the trading funds and trading my own stocks and messing around with technical analysis, since for the last 15 years here, I find that when I'm trying to put indicators together and trying to find a pattern or trying to find, hey, is there something that's more accurate than others? What I want to do is I want to find an indicator from each of these categories, from volume, trend, and the oscillator. And if I'm able to put something together that has these three components, it has a better chance of being accurate. Okay, not always. Okay, you'll notice the vibe, it uses all trend, right? I mean, the vibe uses all trend, but we bring in the oscillator aspect with the 7-day moving average, right? A fresh move above or below triggers the signal. So that brings the oscillator aspect. We bring in the volume aspect, simply not with volume, but with the long-term trend, 50, 100, 200-day moving average. That's going to give us kind of the same thing as a weekly Chaikin money flow. Okay, so the vibe, it brings in all three, but just in a little bit of a different way. But as you put together various indicators or look at different technical setups and say, well, I'm going to use this, that, and the other, it's not about using the MACD and the MACD saying it's going to do this, or using the Williams R saying it's going to do this. It's understanding how they fit together and how they can kind of what that pattern is likely to be. Okay. Obviously, okay, in general, with most indicators, you're trading the trend, you're going to be more accurate because the trend will just help you. Okay, it will just help you. But keep in mind, markets aren't always trending. Markets have been trending here a little bit better this year than they have in a long time. But the norm of the markets over the years, as you look at them, is a more oscillation. And so that's where you kind of see some of these, the MACD really didn't do much good in 08, 09, even 2010. The MACD was kind of ridiculous. That stochastics was fantastic. This year, the stochastics has been rather ridiculous, while a lot of these trend indicators have been much better here. Okay. Max, really good ups. I like your comment there. Your dartboard theory there. And look, that's what proponents or those that don't like technical analysis will argue. They'll say, look, what's the difference between pulling all these calculations and all these things together and analyzing all of this relative to throwing a dart on a board and picking a stock that way? What's the difference? Well, when you pick a stock with dartboard, what's your risk? What's your reward? The thing that technical analysis allows you to do is put the odds generally in your favor, but more than that, understand a little bit better, not perfect, but understand your risk and your reward. Okay, understand that. Hey, look, let's go take Microsoft for example. Okay, we get into Microsoft. Let me pull it up here. We get into Microsoft here as it starts to push higher. We're playing the upside trend, but we know if it breaks that 7 after what it's done, chances are it'll have an aggressive pullback. What it do, it have an aggressive pullback. That's just where the odds were. Okay, Halliburton. Okay, we break down below. We break back down below the 7 in almost the same way as Microsoft. Okay, pushing down below 49. Chances are we have a greater pullback. Doesn't happen. Okay, it's not. We're not going to be able. Technical analysis isn't going to predict all the directions. It's just going to help us understand. Okay, do we have a little more risk here, little less risk here, and we can kind of use it in that way. Alrighty, so those are some of the basic indicators, some of the different things that are out there in regards to indicators. They'll all kind of fall in those categories of oscillator trend and volume. And as we go forward, okay, with 2 more classes to come, we're going to kind of break down a few technical systems where we're putting together various indicators, various oscillators, and volume indications, and looking at how those are used in the marketplace by various individuals. Okay. All right. Well, thanks for hopping on, and we will talk to you later. Take care.